Alright, so next thing we want to talk about is Part B, inventory estimation techniques. So the first one we want to talk about is the gross profit method. Just understand the reason why you estimate your level of inventory is because it's sometimes either difficult or impossible to physically count each unit of inventory. And so if you've got locations all over the place and you sell many different items, it would not be cost efficient to count every item. So that's why we have these estimation techniques. All right, so the gross profit method, also known as the gross margin method, is useful where estimates of inventory are desirable. Now, this is not GAAP, so you can't use this for end of year financial statement purposes, but you can use it for uh, some other purposes. So those purposes are if you have lost, destroyed, or stolen inventory, you can determine the cost of the inventory that's been lost, destroyed, or stolen. Uh, in estimating inventory and cost of goods sold for interim reports, therefore you don't have to have a physical count during the interim, but you still would at the end of year. When the external auditors are testing, well, internal auditors too, the overall reasonableness of inventory amounts reported by their clients. So they're actually talking about external auditors, but it could be used by internal auditors as well. And of course, in budgeting and forecasting. And so, if you recall, when you're calculating uh, ending inventory and cost of goods sold, thus cost of goods sold, you're, and this is true when you're the periodic using the periodic method, you're going to do a physical count at the end of the year. And so you know what your ending inventory is, you know what your beginning inventory is, you know what your purchases are during the period, so you know what your goods available for sale are. If you do your physical count, you know your inventory, ending inventory, and so goods available for sale minus ending inventory equals cost of goods sold. But with the gross profit method, here you figure out your cost of goods sold by estimating it, and thus you can estimate your ending inventory. So it's just the reverse. Rather than figuring out what your ending inventory is and then deriving your cost of goods sold, it's the other way around. Now, how do you do that? Well, it's based upon the relationship that well, you know what your sales are, right? And uh, therefore you should be able to figure out your cost of goods sold. And so, first thing to do is to estimate the inventory cost of goods sold. And so it relies on historical relationships among net sales, cost of goods sold, and gross profit. If you know what your uh, gross profit is, then you can figure out your cost of goods sold. So here we have an example of a company whose estimated gross profit historically is 40% of sales. And so they take net sales, 40% gross profit, you would simply multiply 2 million times 40%. And so um, you deduct that from the net sales to come up with estimated cost of goods sold. Now here you started out with beginning inventory of 600,000 plus you had net purchases of 1.5 million, so you know you've got goods available for sale of 21 or 2.1 million. And so you simply subtract the estimated cost of goods sold and you come up with estimated ending inventory. And so the key to obtaining good estimates is making sure that you have a reliable gross profit ratio. And the authors point out that you can increase the accuracy of your estimate by grouping inventory into pools of product that have similar gross profit relationships. They also note that the company's cost flow assumption should be implicitly considered when estimating the gross profit ratio. And they point out the fact that, doing this, you don't take into account such things as theft or spoilage. It's assumed that whatever is left after subtracting cost of goods sold from cost of goods available for sale is in ending inventory, and that may not be true if you have a material amount of theft or spoilage or both. I'm going to skip over this, but there's the answer. Not feeling real great, as you can tell. Now again, gross profit method is not GAAP, so you cannot use it for financial reporting purposes, except on an interim basis. All right, so here we want to look at something called the retail inventory method. So as it suggests, this would be for high volume retailers who are selling many different items of at low unit prices. And so the principal benefit here is that a physical count of inventory is not required to estimate ending inventory and cost of goods sold. So the first thing you're going to do is you're going to estimate the amount of ending inventory at retail prices. And so the amount of ending inventory at retail is the cost of goods available for sale minus, and that's at retail, of course, and from that you're going to subtract sales at retail. And then from that you're going to take ending inventory and multiply it by the current cost to retail percentage to estimate the ending inventory at cost. And so the formula for the cost to retail percentage is the amount of goods available for sale at cost as your numerator, and the denominator is the goods available for sale at retail. So here we have an example of a company. They figured out beginning inventory at cost in retail. They've added their net purchases at cost in retail and come up with goods available for sale at both. And so they take and they divide 347,200 into the 560,000 and come up with a cost of retail percentage of 62%, meaning of the goods available for sale at cost, it equals 62% of goods available for sale at retail. And then you're going to take and subtract net sales from the goods available for sale at retail to come up with your estimated ending inventory at retail. And then you're going to multiply, in this case 160 times the 62% to come up with the estimated ending inventory at cost. And so in this case, that's 99,200. And so you're going to take that 99,200 ending inventory and subtract it from goods available for sale at cost of 347,200 to come up with your estimated cost of goods sold at cost. And so this provides a more accurate estimate than the gross profit method because it's based on the current relationship between cost and selling prices rather than historical gross profit ratio. And so because of that, this technique is allowed for financial reporting purposes. Understand that this method can be used with different cost flow methods. And you can modify this method to estimate ending inventory of cost and cost of goods sold using FIFO, LIFO, or average cost. Now this next thing they go over is trying to incorporate cost flow assumptions into this method. And note that we'll look at LIFO with the retail inventory method here in a minute. Also note that the book says that the FIFO method with the retail inventory method is used infrequently, so they don't even talk about it. So what we're looking at is weighted average here at the beginning. So first thing you have to do before looking at the weighted average cost flow assumption applying the retail method is knowing some of the terminology that's used. Initial markup. It's the amount of markup from cost to selling price that the company initially puts on a product. And then, as often happens, the price can go up or down from the initial markup. If they increase the selling price subsequent to the initial markup, that is called an additional markup. If they, well, to the extent they do, if they lower the price after marking it up, then that's called markup cancellation. Now that's true as long as the markup cancellation is not below the amount of the initial markup. And so what you have is, or what you can have is, you can have your initial markup, additional markup, and then have all or a portion of that markup canceled through a markdown. Or I guess technically not a markdown, because that means something else. But anyway, bottom line, the markup cancellation has to be certainly below the additional markup, but it can't be less than the initial markup. Okay, we'll look at some examples here. Now, a markdown would be a reduction in selling price below the original selling price, and any markdown cancellation would be getting rid of the markdown below the selling price. But then again, that could be either all of the markdown or part of it, but it doesn't include any markup above the original selling price. And so here's some examples of that. You have your original selling price at $10 per unit. Selling price is raised to $12, so you've got a markup of $2 there. And then after that, the selling price is reduced to $10.50. So you have a markup cancellation of $1.50. And I guess I should have mentioned, my brain's not working completely, the fact that the original cost of this was $6, so the initial markup was $4 to $10. Now, looking at markdowns, let's say you started with 6, you marked it up to 10, so $4 initial markup, and then you mark it down to 7, so that's going to be a markdown of 3. And then next, what you do is you increase the sales price to 8. So you've got, in that instance, a markdown cancellation of $1. And so bottom line is, when applying the retail inventory method, net markups and net markdowns must be included in the determination of ending inventory at retail. And so in that first instance, we had a net markup of 50 cents. And in that second example, you've got a net markdown of $2. And so that's what you would have to include in your determination of ending inventory at retail. And so here's an example of that. So you've got your beginning inventory again. You've got your net purchases at cost and retail, both. got your net markups, $10,000. You got your net markdowns of $8,000, and you got net sales of $434,000. And so you're going to take and include both the net markups and subtract from that the total of beginning inventory at retail, net purchases at retail, plus net markups at retail, and you're going to subtract net markdowns at retail. And so again, once you do that, you're going to divide the goods available for sale, the sum of those numbers at both cost and retail, and then you're going to divide one into the other just like you did before. In this case, now the cost to retail percentage is 64%, and again, like we saw, net sales is 434,000, so the estimated ending inventory at retail is 198,000. And you're simply going to take that amount, 198,000 estimated ending inventory at retail, and multiply it times 64% to come up with estimated ending inventory at cost. Here that's going to be 126,720. You take that number and subtract it from goods available for sale at cost to come up with your estimated cost of goods sold at cost, obviously. Again, I'm going to avoid this because my brain is not exactly working all that great right now. Now you can approximate the average lower of cost or market using what they call the conventional retail method. And so this is just simply taking the net markdowns after you figure out your goods available for sale at retail and at cost. In other words, you don't include the net markdowns in the sum of goods available for sale at retail. You subtract that after you determine goods available for sale at retail. And what that does is it approximates lower of cost or market. And they explain it in the book, and I'll let you read that on your own. And so here, I think they got that backwards. The numerator is going to be 404,480, and the denominator is 640. And so here, your cost to retail percentage is now 63.2%. And again, like we saw before, you figure out your estimated ending inventory at retail by subtracting net sales from goods available for sale, including the net markdowns, which are calculated after determining the cost of retail percentage. And then you take that percentage, you multiply that times, in this case, 198,000, and you come up with 125,136. And so here your estimated cost of goods sold is 279,344. Well, compare that with cost of goods sold in our other illustration. It was 277,760. So cost of goods sold here is higher, which means that gross profit's going to be lower. So when they talk about lower of cost or market, or it approximating lower of cost or market, they're indicating that you're taking a conservative approach here. let's see. Where do I want to go from here? I think I'll skip this. Also, we're skipping dollar value LIFO retail, part C. So let's take a break, come back and talk about part D, change in inventory method and inventory errors.